just super interesting potential outcomes here. And it all boils back to like basically bringing in new capital in. We think we've been kind of shuffling the same chips around for too long. And we think this can basically turn it in from like 100 billion outcome to, or $100 billion industry in DeFi to like, $1 trillion.
Thanks for jumping on. I appreciate you. Very, very busy. You've got more products and every single week I see you guys push your products at the minute. So how's it all been going?
Good, yeah, pretty busy. As you said, we've got something new every week. But as I said, I think the opposite would be a lot worse. So it's a good problem to have.
Awesome. And you guys have caught lightning in a bottle, and it feels like stablecoins. And I've said this, and I don't know if I'm being hyperbolic, and you've probably got a very unique understanding and position of where I'm coming from here, but it feels like stablecoins are probably one of the most high opportunity products, not just in crypto. I think this is across all of tech at the minute. Anything to unpack on that?
Yeah, it's interesting. It's obviously, it feels like it's top of everyone's mind right now. I think stablecoins have always been like a fundamental use case of crypto. It's nearly like cringe and cliche now to talk about crypto. Or stablecoin is crypto's killer app. Everyone's done it. So I think that's been talked about ad nauseum. I think it's more of a case of like, why now? And I think you look at the other narratives in the space over the last few years, and none of them have really kicked on to do anything meaningful. Whether that was, it probably started with like NFTs a couple of years ago, moved on to things like liquid staking and restaking last year, AI agents, meme coins. They all the narratives kind of come and go. And what's fundamentally has stayed over the last few years has probably been two use cases. One being speculation, which crypto is kind of remarkably good at, allowing people to speculate on the long tail of assets. That will always probably be a use case for crypto. And you look at like two of the most successful businesses out of the last cycle were probably Hyperliquid and Pump.Fun, who were very much in that narrative. Then you look at the other narrative as obviously being stablecoins. And I think everyone understands why they're important, giving everyone in the globe kind of access to dollar exposure and dollar yields. Super important. And as I said, it's been talked about ad nauseum. And I think you look at maybe another two like successful businesses this cycle, and it's obviously like Tether, who are just kind of perennially successful. Obviously, one of the most efficient businesses probably in the world in terms of their revenue per employees. And then obviously I'm a bit biased, but you might say Ethena then as well. And I think people just look at those successful businesses from the last cycle and kind of put two and two together and come back to the two things, which is stablecoins and speculation. And you probably look at which you'd rather export to like TradFi and export to like new pools of capital. It's probably stablecoins rather than allowing BlackRock to speculate in assets. So I think that kind of answers the question as to like why now, pretty much.
Awesome. Yeah, great roundup. Great points on that. And 100%, the amount of people that say stablecoins are the crypto like killer products is absolutely ridiculous. I think even 2 years ago I wrote that in a thesis, so I'm sat cringing at myself for writing that now. So you touched upon it briefly there, but I think this style of podcast, particularly speaking about stablecoins as a whole and then driven down into Ethena, there's going to be some people coming in cold. So can you kind of give those people that have definitely heard of the word and the term Ethena, they might closely associated with stablecoins, but can you give them like high, just like basic understanding and warm them up to the product?
For sure. Yeah. So Ethena are a synthetic dollar issuer, which is USDe. And essentially what that means is we take in crypto collateral and we hedge out the crypto collateral with short perpetual future positions. So the effect of that is then you have offsetting positions from a P&L perspective, where if the spot collateral, let's say Bitcoin, goes up in value, your short perpetual future hedge goes down in value, and the two should net off. And the output of that is this dollar denominated asset, USDe. What's interesting about Ethena is that that setup as a delta neutral stablecoin has obviously been tried before. Some examples are like USDe, and essentially what the previous iterations tried and probably failed in other cycles was they stuck to decentralized exchanges who have like a fraction of the market size pretty much and open interest to hedge into. So What's interesting about Ethena is obviously we opened up to access centralized liquidity on centralized exchanges like Binance, Bybit, OKEx. We do that through institutional grade custodians. So that's introducing kind of a term, I guess, to the industry called off exchange custody, which basically means that the assets backing USDe sit off exchange. So they're not actually on the exchange themselves. We thought that was a pretty like fundamental design choice, especially in the wake of like the FTX collapse and everything. I don't think we could have come out to users and said we have all the assets sitting on the exchange itself. And we might get into it later, but we saw that kind of vindicated throughout the Bybit hack in February, which was super interesting and kind of demonstrated that design choice in real time. What's also interesting about the delta neutral setup is that you're quite capital efficient. You're basically collateralized 1-to-1 because you have the spot side and the hedge. You don't need to go over collateralized by like 1.5 to 1. Which is pretty interesting in terms of growing to like $1 billion size. And then probably the biggest value add for Ethena is being able to collect the funding rates on the short side of the perpetual future trade. So funding rates, for anyone that don't know, is basically the rate paid to balance out demand in perpetual futures markets. And as it happens, and probably understandably, there's more demand to go long crypto assets than short crypto assets. So what we've seen over the last 4 years is the funding rates have averaged about 8 or 9% being paid to the short side per year. So sitting there, you're obviously delta neutral and collateralized 1-to-1, but you're also able to collect this funding rate of 8 or 9%, which is a completely new kind of source of revenue for any kind of crypto protocol, which is super interesting. And we could probably dive into that. But it led to SUSD pretty much averaging 18% over the course of last year, and pretty much setting a new benchmark for the kind of rates in DeFi.
This episode is brought to you by Morph and their new Black Card. So everyone knows how annoying off-ramps can be in crypto, particularly when you've got 99% of your net worth tied up on-chain. The Morph Black Card allows you to spend your on-chain assets, just as you would with any traditional debit card. Plus, you can earn up to around 30% APY on your assets just while it's sat in your account. So enjoy unlimited withdrawals up to $1 million USDT with 0 annual fees, a premium weighted 22 gram black and gold card, plus you get 1% cash back on every purchase. So to grab yours today, head to the link in the show notes. T's and C's applied. Yeah, incredible. And like we already obviously had, we touched upon Tether and like the Circle with USDC and USDT as I suppose the first kind of like stablecoins to really take off. There's definitely some trade-offs there, and there's like the whole stablecoin trilemma angle that people will speak about. We had algorithmic stablecoins that like RIP, and then crypto-backed stablecoins that were purely, I suppose, under-collateralized against and dependent on how much actual crypto collateral you can put into them. And then obviously you guys have came onto the market with this completely new model that kind of like revolutionized, and we tested if there was demand, and you guys ended up getting to 5 billion. And probably is it the fastest growing stablecoin to 5 billion in existence?
Yeah.
Expected?
I'd probably be lying to you if I said it was expected. Yeah. I think it was expected, or not expected, but it wasn't like an accident either, I think is the way I'd put it. You look at even our like early fundraising decks to investors, and we probably had 5 billion as a potential outcome for this. The reason for that is, as I said, the design choices we took and the trade-offs, which were probably quite like controversial at the time when Ethena launched, especially when previous iterations, as I said, and it's probably like a natural evolution of crypto in general, is kind of moving away from this like pure decentralized DeFi into maybe a more pragmatic approach, with the end goal of hopefully onboarding more capital and tokenizing more assets. But it's, as I said, it's the nature of the design choices we made to open this up into like $1 billion potential outcome. You look at centralized exchange liquidity in perpetual futures, and they're literally 30x the size of decentralized markets. So we knew we had to try and find a way to tap into that market. And what kind of appealed to me initially about Ethena as well in the early days was that it was, as you said, this fundamentally new design that hadn't been tried before, but that also meant there was like zero competition. And when you think of like cash flow opportunities in crypto that are in the $1 billion of size, there's very, very few. That's basically, you're either like an exchange, you're either a layer one or else you're tapping into the funding rates in perpetual futures markets. So those markets are about 50 billion in size, paying 10%. So there's like a 5 billion cash flow opportunity per year there for people that to try and capitalize on. And yeah, Ethena launched, and it's still nearly to this day has minimal competition in that market in like $1 billion opportunity size. So yeah, I'd say we didn't expect the growth to be maybe so quick, but again, it didn't really surprise us in terms of like we thought there was a non-zero chance that happened based off of the kind of decisions we made in the trade-offs.
Yeah, and there was, like, I think it's fair to say there was, as with all things in this industry, there was a lot of, I don't know if skepticism's too harsh of a word, but there definitely were a lot of loud voices in the early days as well. And like, how do you guys take those internally? And because the idiots in the room are always the loudest, and you've kind of shown with the product and kind of like answered a lot of the questions from like naysayers and stuff like that. But was there any kind of like work on how you position this? Was there any work on how you deliver the messaging around this? Like, how did you kind of like take that? I really don't want to say the word criticism, but you know what I mean? There was, because of a novel new product coming online, Luna last cycle, which was very raw in everyone's mind. I'm not saying in any way, shape, or form these two products are correlated, because they couldn't be further apart. Are these kind of like connotations that people tie to stuff that they don't fully understand? So was any of that factored into the rollout of the product?
For sure, it was pretty much the main like narrative we were fighting to start, and actually like it is rightly so. Like we would get frustrated at it internally, but we kind of understood where people were coming from and being like skeptical about a new stablecoin design. After we launched at such a unique time, obviously post Terra, post FTX collapse, people were skeptical of anything that was new, and they weren't very familiar with. So yeah, we just try to take the approach of like, even if you look at kind of our docs, again, I'm biased, but I'd say they're pretty extensive, and we go through like risk by risk. We outline 6 or 7 different potential risks, both like financial and everything else, in terms just to get users comfortable with this was a new product that was getting launched. Here are the risks, and pretty much get involved at your own basically we're all adults here. Once you kind of understand the risks and we're transparent enough about the risks, everyone can make their own decisions. We spent a lot of time in the first 6 months to a year getting people comfortable with like the data involved with like funding rates. A lot of people's skepticism was revolved around, what if funding rates went negative? What if an exchange gets hacked? And obviously it's easier to like answer these questions in real time, which we're doing now. For instance, the exchange being hacked, like surviving that, funding rates being negative, we've survived that. But before that's actually out in the open, you're really just trying to show people the data and get people comfortable with the data in terms of like funding rates being negative in an X amount of days in the past. So we were super conscious of that, and we just tried to understand users like skepticism and kind of turn it into an opportunity for us to educate them on the design choices. Even you'll notice we try and avoid calling USDe a stablecoin. We call it a synthetic dollar for that very reason, is that we don't want to give any kind of false narrative, and try and learn from previous iterations of whether it was Terra or any other stablecoins that were supposed to be stable and weren't. And we kind of understand this is fundamentally different to just holding cash in a bank. So we want to be kind of transparent with the users in that sense.
Yeah, and I was going to get into both of those 2 points, but I suppose we'll get into it now as we just kind of, it's a smoother transition. So the short leg entering negative funding, can you highlight for people who are still trying to wrap their head around the first part of the conversation what that means, and how you guys are currently navigating and performing against what I can imagine is being a very short bias market currently, because we're recording this on the 8th of April. Don't open TradingView. Don't look at what's happening in the markets. It's quite bad. But can you talk us through that aspect of it, and how you guys are performing, and what that's been like to kind of go through very robust and turbulent markets
For sure.
over the past couple of weeks? And then we'll touch on the other aspects with what happened with Bybit and stuff like that.
Yeah, for sure. So as you said, it's a unique kind of setup we're in right now. For the last few weeks, really for the first time since Ethena launched, funding rates have been performing like below T-bill rates. They're still not quite negative, but they're in the low single digits. And yeah, initially when Ethena launched, we obviously launched with this reserve fund on the side. That's supposed to earn a share of protocol revenue and build up throughout time. That's at a size now where it's at about 60 million in size, so quite a decent size. And that was initially our go-to answer for how we solve negative funding rates. Is that firstly, obviously, show them the data that like funding rates are only negative on less than 10% of days throughout history. But then also on the days they are, this reserve fund has been sized to handle those negative days and kind of compensate protocol revenue. What's interesting in like the evolution of Ethena is that really what we learned is that it doesn't make sense to kind of keep 5 billion worth of perpetual future positions open if they're yielding less than T-bills, or worse yet, obviously yielding negative. So what we started doing probably 6 months ago is kind of introduce this like dynamic allocation of the backing of USDe specifically towards like yield bearing stablecoins. One of which is our own stablecoin USDTB, which is backed by Biddle. And what we've seen now is like over 50% of USD's backing is now actually in that liquid stable allocation and not actually allocated to perps at all. So it's interesting in that it kind of makes the like protocol revenue a bit more all weather, in that hopefully it sets like a floor and like a more resilient SUSD APY in terms of hopefully it's going to kind of like yield close to like T-bills in a worst case scenario when we shift that allocation more into liquid stables. And then obviously in more kind of bull markets, you have the upside of moving more into perps and taking advantage of like double digit funding rates. So I think the solution we've arrived at now is a lot cleaner in terms of like you adapt dynamically to whatever the market situation is. And we've done that kind of like multiple times, whether that's cases of market panic or just kind of slow underperformance of perps. It's been a gradual shift from 4 months ago, it probably would have been only like 5 or 10% of the portfolio in liquid stables, and now it's, as I said, over 50%. So that's just like an evolution of Ethena and something we've kind of learned over time, and hopefully like provides a cleaner solution, I think.
Yeah, 100%. It makes an awful lot of sense, and as I say, but it's kind of like squashes one of the main, I suppose, questions that everyone would have when they come into learn about a product like this for the first time. The other is obviously with what happened with Bybit, which was just kind of like a wild situation, like in general, like with Safe and stuff like that. Yeah, just absolutely wild. But can you talk us through like what happened and what was going on behind the scenes with you guys, and like how that played out, and just kind of give people like a clearer picture of what actually happened in general?
Yeah, definitely. So at the time, it was obviously like looking quite bad for the industry in general and Bybit and everything. And obviously, the first call of a lot of people was, how is Ethena going to survive this? And obviously, in hindsight, it's nearly like quite vindicating to see that design choice play out in real time. As I said, Ethena uses off-exchange custody solutions. So specifically for Bybit, Copper is the associated custodian, and the assets that back our Bybit positions actually reside in Copper. So yeah, what was super interesting about that is that like we were able to show in real time that look, even if Bybit went down, we can basically delegate non-delegate positions to other exchanges. So within the first like hour or two of the news breaking, we had kind of delegated about 400 million, I think, worth of positions from Bybit to Binance. And yeah, it was just kind of like a real-time look as to answering one of the biggest questions on everyone's mind, which is, how does it like Ethena survive a Bybit hack? And yeah, it goes back to us accessing centralized liquidity, but doing it in a way that like users can get comfortable with. And now we've seen these off-exchange custodians kind of work and solve that problem in real time. And yeah, what we've seen since then is like Ethena being able to build even more trust in the markets. We've seen even in this dip in the last few weeks, a USDe supply has been quite resilient. It's down a couple hundred million maybe, whereas if this was this kind of dip maybe 6 months ago or pre-Bybit hack, I think we would have seen a lot more redemptions in USDe. So yeah, look, and even during the Bybit hack, it was our largest day of redemptions. I think we redeemed over 200 million. people, I think, were trying to basically kind of put us under the microscope and test us out. USDe peg barely moved off like 10 bips of peg. And yeah, at the time it was obviously a very scary moment, but looking back and kind of once you're through the like fog of war, it was pretty vindicating to prove that real time custodian, like off exchange custody solution actually works.
Yeah, it must be might sleep like an extra 5 or 10% better at night after letting all that play out.
It was an all-nighter for everyone, I think.
What I want to ask is, stablecoins are notoriously really difficult to get off the ground, and like cold start problems are really, really difficult. And what people will tend to do, whether it's a similar sort of product to yours, which you're starting to see a lot more of go online, or any form of stablecoin, right? They tend to just throw token emissions at the problem and try and use token incentives to, whether it be utility or governance token, to just let's just throw that at the problem and see if that sticks. That works for a while until it doesn't. Some people make it over the chasm, some people don't. But how do you make, and how did you guys go about? There's a lot of people that are very opportunistic in the market, and how did you kind of discern, right, we really need to highlight that incentives are not the product from t equals 0 from like day one, because that's typically what happens in the industry, and it also starts to attract like negative use case and negative connotation, and people just like, oh, I'm just going to farm as much as I physically can with this. But a lot of people do not make it to the other side. Like, it's probably a handful of teams that actually do it. But is there any kind of like thoughts to double click on that aspect of it?
It's definitely interesting. It's a trend we've seen, I guess, over the last cycle, is just even like products launching a token before their actual product, and that's just like
no names mentioned.
But it was like the nice thing about us. Obviously, there was a lot of luck involved with the timing, but we launched USDe and SUSDe a good 4 or 5 months before Ethena was actually launched. We had like 400 million worth of SUSDe earning like 20% funding. And what's nice about that is people are actually seeing the product and the use case for the product in real time. So we had nearly like, it sounds nearly too cocky to say found product market fit, but we had found at least some level of interest in the product before we had any incentives involved. What was nice about Ethena then was that obviously we had that like pickup on the actual product itself, and we were able to then put like token incentives in like the first season of our points program on top of that. And that particularly helped with kind of like just especially bootstrapping liquidity on like partner protocols. I think that's where token incentives can really play a important part in growth. I think when you're using them as a crutch, it's a bit different. But I just think it starts fundamentally with like an important product that solves some kind of problem. It's not just like, the 100th iteration on an RWA asset that offers slightly less fees or something like that. Especially with Ethena, it was this like kind of, as I said, fundamentally new design that opened up a new source of revenue, and we saw the outcome of that. And obviously, again, we launched at a good time. I think February 2024 and January was like 30-40% funding yields, which was pretty great to go out to market with. So we were definitely lucky in that sense. But as I said, we did have that product nearly before any kind of incentives were launched.
Yeah, and after that stage, when it hits like that inflection point, do you, like, just to give kind of listeners a bit of a peek behind the curtain, does a lot of inbound from different DeFi protocols all come at once, and they're like, oh shit, this thing's real, this thing's here to stay, this is like a new paradigm? Or was there any, like, what did like the inbound versus outbound like BD look like there? I can imagine a lot of people wanted a lot of TVL into their protocols.
It was pretty much, once you kind of go through that like initial launch phase and amass that kind of attention, that's nearly the hardest part. It's like crypto is just such an attention game that once we had that attention, everything kind of fell into place there. What was again interesting about us was that you had protocols and kind of like treasuries suddenly start asking themselves the question, okay, this is a way to get like 15-20% dollar denominated returns on our treasury that's earning in like Tether or Circle or whatever, earning zero. So you had a ton of protocols ask themselves kind of, okay, how can we capitalize off this push? It wasn't just okay, how do we like satisfy the user demand here? It was also like, maybe if we have like 18% rewards on this, we can pay users 15 and keep 3. So there was a lot of interest and dynamics going on. And yeah, the BD efforts were helped a lot by that. For sure, once we had people's attention, but then also, again, it comes back to having something that was like net new to the market. And then you're posing that question to people in terms of looking at their own like capital efficiency on their own assets as well.
So I want to ask you something that you mentioned probably the first 5-10 minutes into the show. So you mentioned a movement away from trying to focus too much on, I suppose, purely decentralization over pragmatic use. So we're starting to see this as a trend, not just within your product suite, which I'd like you to expand on, but like there's a lot of teams that are, I think, begin to ask the question and begin to push product and asking of the market, where do we want on this spectrum between terrible UX but is purely permissionless, decentralized, and all the ideological dreams of what crypto could be, versus pragmatism and maybe some trade-offs with regard to that. And there's like, that is a very like wide spectrum, and maybe it comes full circle at one point. But do you have any thoughts on that initially? And I want to ask you about like the institutional products that you guys have got, and then use this as a bit of a segue into Converge.
Yeah, I think Ethena specifically is obviously quite unique in the trade-offs we made. I think you're asking us, and we're probably pretty biased in that we say, obviously, we prefer like a pragmatic approach. A lot of the team itself comes from like a TradFi background. Guy, the founder, we used to work in like a hedge fund and everything. We have this kind of like very, I don't want to say a TradFi orientated approach, but it is like a pragmatic approach. We aren't like DeFi engineers that are purely focused on like decentralization and things like that. Ethena was launched knowing that this was probably going to be slightly like controversial to some people, but in order for the space to mature and grow, like we did this stuff in 2017, we saw kind of how it worked out. It went through a kind of great period of growth, but then it just kind of like plateaus eventually because you're trying to onboard this new capital and they just can't get involved with, as you said, like a worse UX and yeah, different things like smart contract hacks and stuff like that. So we obviously made the decision when we launched to launch with a more pragmatic approach to open up that $1 billion outcome. Obviously, we did quite well out of that decision. If we had just stuck to decentralized exchanges, you'd be looking at USDe at like 100 million size maybe now. And yeah, so we have that approach where we think you're trying to solve for, it's really a question of what you're trying to solve for. We're trying to solve for how do we onboard and tokenize the most amount of like sideline capital into crypto. We obviously think the most amount of sideline capital is in TradFi. And the problem being that obviously I think a lot of TradFi can't really interact with DeFi in its current state. We've just talked for so long about the institutions are coming, and bar maybe the ETFs, they haven't been able to get involved. So we do have to start kind of asking ourselves questions as an industry, looking at ourselves and being like, okay, what have we actually done as an industry to make it easier for institutions to come on board here and bring in the sideline capital? Even if you look at like crypto market cap now, it's kind of like plateaued, hasn't reached like new highs every cycle that it used to. And we just think, obviously, this probably leads us on to Converge, but why not us to be the ones that kind of build that infrastructure? And we obviously have experience with building out a pretty like flourishing DeFi ecosystem as well. And yeah, we partner with someone like Securitize who have the experience in tokenizing assets for TradFi, and they have that network and that clientele. And between the two of us, we feel like we should at least try and like improve on the infrastructure here to kind of make it easier for TradFi to come in and get involved in the space.
Yeah, so let's like go head first into this. No armbands, no nothing. Like Converge. So this comes out in the timeline. I'm just scrolling through. I'm like, what's going on here? This is potentially huge. You've kind of just set the scene there, but can you give people who might not have been paying attention because they don't want to open Twitter and be greeted with people losing their mind. What are you guys doing with Converge? I know you mentioned Securitize as well there. What's their role? Just like high level, I'm going to probably ask way too many questions after this point.
Yeah, so essentially Converge is our blockchain initiative in partnership, as I said, with Securitize. Securitize will kind of help tokenize assets there, and it doesn't have to be even tokenized T-bills, which is pretty much the only product we've been successful as an industry at tokenizing to date. But you can think of other things, hopefully, like further down the line, other securities we can tokenize and things like that. And what Converge is obviously combining Securitize's expertise with, as I said, Ethena's expertise and even just our assets, and bringing them onto like a new chain with the two of us involved. You will have the normal kind of permissionless ecosystem on that chain, which I think is important to say and maybe got lost in a lot of the noise. Like we've got commitments from partners like Aave, Pendle, Morpho, who we have like billions of dollars worth of USDe with. Let's say like Pendle have 1 or 2 billion of USDe on Pendle. So that like DeFi permissionless ecosystem that kind of we know and love will still be present on this chain. It's still possible to like permissionlessly launch apps on the chain. It will have a permission side as well, which we think is part of building this infrastructure that TradFi can get involved with. So just even conversations with some of TradFi, a lot of them can't, as I said, interact with smart contracts in their current form. They need maybe a more permission solution. So that kind of brings us to like our asset IUSDe, which we are launching obviously in collaboration with Securitize again. And you can think of that as just essentially like a more institutional friendly version of USDe with a kind of compliant wrapper around it. And what you have there is now all of a sudden that hopefully TradFi can avail of this, like, as I said, unique kind of APY that SUSDe offers. And we can build products on top of that APY, which is super interesting. So you have obviously the simple way to think about that is permission version of the current products that we have. So permissioned money markets, permissioned interest rate vehicles like Pendle. But then you could also have like permission versions of like a poly market or something like that, where the collateral is earning a yield and just super interesting potential outcomes here. And it all boils back to like basically bringing in new capital in. We think we've been kind of shuffling the same chips around for too long. And we think this can basically turn it in from like $100 billion outcome to, or $100 billion industry in DeFi to like, $1 trillion potential.
Yeah. What's like, anecdotally, what are those conversations with the big institutions in the TradFi players that are sat on the sidelines, and are they just like, are their hands just completely tied? Do they need like infrastructure like Converge to be able to like dip their feet in? Like, what is their appetite? Like, what's those conversations looking like for us plebs?
Yeah. Like the conversation wise that, exactly like you said, their hands are tied right now. And even if you're looking at like an institution, it's harder to justify putting money, as I said, in a smart contract. Or is that like, you could argue that that's a lot riskier than having it in like with a custodian solution, whose job is to keep the assets safe. Like we've seen billions and billions worth of hacks in DeFi every year. So, and then obviously you have the compliance issue with like OFAC sanctioned entities involved, or potentially like validator rewards from North Korean transactions, things like this that you just don't really think of, that they do have to think of. And we might want to offer them the full permissionless ecosystem, but a lot of them just can't get involved. And this is hopefully a step in the right direction for the infra in terms of getting them involved.
Yeah, that makes a lot of sense. It's quite interesting to see as there's been like, as you mentioned, like even with USDe, stuff that's kind of been tried before, but I just don't think either from a regulatory perspective or even an infrastructure perspective, we've been kind of ready for it. But it doesn't like kind of throw shade at those like first attempts, but it feels like we're somewhat coming full circle on a lot of products. But if we're ever going to crack it, I feel like the infra's there to actually go and do it now, which previously I was a little bit, this might be a little bit too early, but all the pieces seem to be falling into place now.
Yeah, exactly. And I think, a big part of that is probably getting them comfortable with the space in general. Like even just, conversations like crypto has inserted itself. It feels like in the like stock market narrative and things like that. It's on CNBC regularly. We have the ETFs now. People are a lot more comfortable with it, so we have the attention, and it's like normal enough for entities to come in and get involved in the space. But again, they just need some kind of like regulatory compliant solution to do that. And yeah, we feel like between us and Securitize, we're in probably one of the best positions to do that. And then hopefully they find the kind of like delta neutral funding rate arbitrage pretty interesting from a returns point of view. Worth noting as well, they're pretty familiar with that in terms of like basis trading in TradFi. It looks very similar to that. So it's a product they're kind of like comfortable with anyway. They understand the risks for them. They kind of know the risks of like, negative funding and drawdowns and things like that. They understand those risks. It's just about getting them comfortable with like the infra side of things, really.
Yeah, and is there anything that you guys have released on, I suppose, the architecture, like native token for gas, like which tokens are going to play which parts of the network? Like, what does that, I suppose, user experience and architecture look like if it's available?
Yeah, so we're following up with like the full tech stack in a few days. So like probably limited as to what I can say there. USDe and USDTB will be used as like gas tokens on the network. Ethena
Gotcha.
then will be used by validators to kind of secure the network as well. So we hope that that can kind of align a lot of the different Ethena products involved there. But yeah, as I said, we're kind of limited, unfortunately, with what we can say just before we kind of finalize everything there.
No worries. I'm sure we'll cover it in an article or something anyway at the time. Right. Let me just find it. Let's make a note of this point. So obviously this is kind of like adjacent to the conversation we're having now, but we've had I think it's like one of the worst 3-day returns in stock market history. And you get second and third and fourth order effects on the crypto market as a whole. How are you guys thinking about this internally? Is it affecting performance at all? Is it kind of showing you anything, or like, just kind of, I'm just asking everyone this question now because it's very unprecedented times.
Yeah, I think for us specifically, it comes back to the decision around funding rates and things like that, and how can we make the assets back in USDe the most efficient they can be. So there's a lot of decisions internally on the trading team in terms of the allocation to like liquid stables and T-bills, and we're keeping kind of a close eye on funding. Obviously, there's kind of less demand to go long at the moment for obvious reasons, which does impact us, but as I said, we found a solution now where we hopefully can provide a more like resilient protocol revenue at the end of the day. There's other solutions that like are being explored with onboarding other assets and things like that. So it's just kind of like, again, it's probably what every crypto project is asking themselves at this stage, is kind of like, okay, what can we do to make ourselves more efficient and more all weather in terms of that we're not so reliant on like prices or anything like that.
Yeah, I was going to ask, again, you might not be able to answer, but with kind of, I suppose, leaning into the pragmatism, there's quite a lot of around ETH, like for better or for worse, and like if you agree with that or disagree with that. I think it's a little bit overblown at this point, to be perfectly honest, and I've been quite a strong critic myself. But yeah, is there potential for different baskets of assets to support USDe? Like, is that in the works, or is there anything you can kind of tell us about that?
So at the moment, for a bit of context, it's like Bitcoin, ETH, and a small amount of Sol, back USDe, and obviously their corresponding short perpetual future positions. Initially, what was interesting about Ethena is that we launched with like liquid staking tokens back in USDe. The problem is that just doesn't really scale. But it was nice when we first launched because you're getting like a 3-4% yield pickup on some of the backing, which was nice. But as we always knew, as we grew, we had to add more assets, specifically Bitcoin and ETH. Now obviously we've added Sol recently enough, and that's a kind of untapped market for us in general. So hopefully we kind of have exposure to maybe the Sol market growing over the next few years, and that kind of just increases the capacity on USDe. There's other more interesting things that you could potentially look at, like if we have a couple of billion of USDTB backing USDe now, can we actually then maybe like lend that into a money market like an Aave? and pick up an extra 2 or 3% yield on that. And obviously, maybe that's one for like our own governance to decide if they're happy enough with maybe the risk there and things like that. But yeah, kind of boils back to just thinking about the different like evolution of assets and USDe, and we do look a lot different to how we initially launched a year ago, and we're just kind of constantly learning as to like what the most efficient way to optimize the backing, let's say.
Nice. So is there anything else I might have missed that you want to make people aware of? I appreciate we've covered an awful lot there, and there's a lot to digest, so people might want to re-listen to that one. But yeah, is there anything I might have missed that you want to kind of highlight?
I don't think so. No. No, honestly, there's not really. We're pretty busy launching Converge at the moment, which we're, again, excited for. Hopefully that's going to launch within like the next quarter or so. And as I said, we'll have like tech details to follow on that. I know everyone's like super eager to nitpick on those. There was a lot of assumptions on Twitter in the first on the release, which is, again, fair enough for people to be skeptical, but hopefully we've proven ourselves to be like good enough executors now. It's like every part of our roadmap we've executed on so far. So we're kind of relying on doing the same again here, and we're pretty hopeful we can kind of be the ones to onboard this next pool of capital, and the institutions are finally coming, hopefully.
Yeah, absolutely. Well, Conor, thanks very much for your time, mate. I appreciate you jumping on. I know you guys are super busy, so I really, really appreciate your time. Anyone who's listening, if there's any kind of like show notes to pick out from that, like the video production team, I'll leave all the show notes in the description below. If you haven't subscribed yet, then I don't know what you're doing. Have a really long, hard look in the mirror, and we'll see you next week. See ya.
Quick one, nothing here is financial advice. It's for entertainment and educational purposes only. Always do your own research or speak to a financial advisor before making any investment decisions.